Welcome to the Live Big podcast, where real estate expert Nick Paynes shows you that everyone can build wealth through real estate investing. Nick and his featured guests will give you the tools, resources, and expert information you need to leverage real estate into a wealth-building strategy, so you can stop worrying about your 9-to-5 and start to live big. Here's Nick with today's episode.
Hello, everybody. Welcome back to the Live Big podcast. Today, I'm excited to present you Kim Lochridge. She's the Executive Vice President for Engineered Tax Services, and she kind of helps people implement tax strategies to really help them keep the money they earn. So she's highly knowledgeable. She's works with Fortune 500, high net worth individuals. She works for single and multifamily architects, engineers, CPAs, and she's a real estate investor herself, right? How long have you been investing in real estate, Kim?
The late 90s.
That's awesome. That's awesome. So welcome. Thank you for being here. We appreciate it. And I think we've got a lot to learn today. So I'm excited to get kind of right into it. So tell me a little bit about your background with your real estate investing. And that's really what this podcast is about, is for real estate investors. So love to hear kind of your experience as a real estate investor. And then we'll get into today's topic a little bit.
Yeah. Thanks for the opportunity and thanks for having me on the show. I appreciate it, Nick.
Yeah.
So my investing started, probably like most people investing, buying a house, buying a second home, and kind of going into, instead of moving, and selling it, just renting it out and buying another one, developing, some real estate, portfolios, growing up into, now we have, cannabis warehouses, gas stations, mobile home parks, hostel, single family rentals, whether long-term rentals, short-term rentals. So we manage a portfolio of both of those. And my husband quit his job a couple years ago after 29 years to become our real estate professional, so that we can offset my income and some of the other income from the property. So we're kind of living what we preach, in day to day and everything that I do with engineered tax services. And we're not just, a provider, but I'm actually living it every day right alongside all of our clients.
That's awesome. And now the mobile home and some of the bigger stuff, are you doing those through syndication? And are you, if you are doing them through syndication, are you on the GP side, or are you limited partner? How are you involved in those?
Yeah, the mobile home parks we bought by ourselves. I think my husband thought I was crazy when I told him, I start seeing trends across the country, and that was a trend that I saw that, I basically went to him a few years ago and I says, we've got to buy mobile home parks. And he was like, what? You are crazy. Yeah, a little bit insane, but did it and bought a couple of those and doing very well. Managed them all of ourselves. So we don't have a property management company doing it. We did it all ourselves. We had a property manager on one of them, but sorry, property managers out there. There's not very many honest of them. So I ended up firing him and doing it ourselves. So
got it. So that's why the husband had to quit the job. He's got to start managing property.
Yeah, it got to the point where it's like, man, this is killing me right now, because I was trying to do this and the management. And so, we did that. Plus we manage about 5 Airbnbs and then the eight doors just on our own. And then we have a syndication with about 800 doors in Texas and 14 cannabis warehouses and a couple other things that are larger. And then we bought the gas station on our own. So it's a hodgepodge of, kind of a mixture of portfolio.
Sure. And that syndication stuff, are you in the limited partner or general partner side?
I'm usually a limited partner on the GP side, if that makes sense. It's not only because I usually sit on the board, and so I kind of get paid at the GP level, but I'm technically an LP. But I usually am so involved with what they're doing in real estate, and I have a lot to contribute. So I usually get some deals.
Nice, that's awesome. Yeah. Well, cool. Well, thanks for the background. That's awesome. I love kind of getting the individuals that and you have experience all over the place, right? Like we've talked about, we've had episodes on short-term rentals, long-term rentals, and some of the bigger commercial stuff. So it's kind of cool that you're kind of delved in all of it a little bit. What's your favorite one, by the way? How about what's your best ROI?
Oh, the cannabis warehouses.
Yeah, by far.
By far.
That's cool.
I will do those all day long.
That's awesome.
With a specific group.
Sure.
There were some bad ones that I've been involved in, and it was I learned my lesson. But yeah, I've got a group that I invest with, and easy 22% IRRs.
That's awesome. Wow. That's
unlevered. Incredible. So that's more like 26%.
Absolutely.
So those are pretty good. Those are my favorites.
That's awesome. Great. Well, cool. Well, today what we want to talk about is really what you specialize in through engineered tax services, and that's cost segregation. Obviously, I know that you guys' company and you have a parent company that offers some more services, and they're kind of advisory services for high net worth individuals and helping people tax shelter and things like that. But I want to talk about cost segregation because I think there's a misconception out there that cost segregation, first of all, most people don't know what cost segregation is. Second of all, once they do understand it, they believe maybe it's for people that are at that super high level, maybe somebody who owns 800 units or maybe somebody that's doing big commercial buildings, but that doesn't necessarily have to be the case. So I'd really like to start with, can you just give us like a 60,000 foot view of cost seg and like what is it and how does it work? So just give us if somebody called you today and was like, hey, what's this about? My friend told me that I should do some cost segregation. Can you tell me about it? How would that conversation go?
Yeah. Well, yeah, cost segregation is very interesting, and there are a ton of misconceptions. And it's really funny because on the internet, I see a lot of TikTok videos and, podcasts even, and there are a lot of people out there that are misrepresenting cost segregation. Even if they think they're an expert, I think there's a lot of people that, because they do a couple of cost segs, they think they're experts, and then they get on a YouTube video and tell everybody about it. But there are some ins and outs, right? And just like with any other tax product. But cost segregation in a nutshell, the first thing that I think is very interesting is cost seg has been around since the 1940s. Everybody seems to think that, this is new because bonus depreciation got enhanced in 2017, but bonus depreciation in itself has actually been around since 2006 in some shape or form. But cost segregation has been around for a long time, and this isn't, I think it's now it's just hitting mainstream because of this 2017 Tax Cuts and Jobs Act, where it enhanced it and covered purchase property instead of just new construction. And so everybody started talking about it, and it was the new shiny toy. And so everybody thought it was new, but it hasn't. It wasn't new, and it hasn't been new. So a lot of people are confused about cost segregation and bonus depreciation. They think that bonus depreciation is cost seg or vice versa. So hopefully we'll be able to clear that up today as well. Don't believe everything you hear on a TikTok video. Even if they actually come off like they know what they're doing, please check them, vet them, make sure that you're getting good information. And, I always refer them back to their CPAs, because the CPA is going to know most of the time whether or not you can utilize these types of tax deductions or tax incentives. But in a nutshell, cost segregation is a tool. And instead of, so if you buy a property and you don't do cost seg, essentially your CPA is going to depreciate that asset over a straight line depreciation. That'll be 27 and a half years if it is residential and 39 years if it's commercial. Some caveats and exceptions to that rule, but that's the general rule of thumb. So essentially, when you buy a short-term rental, for instance, and it's got carpet and, you've got paint, all this stuff in this, decorative lighting, and you're making it really nice, and you have all these finishes in the house, and wood trim or molding or crown molding, whatever you're doing. All of that stuff is if you don't do a cost seg, depreciated over 27 and a half years. Actually, short-term rentals are 39 years because that's one of the caveats. But the IRS actually treats that as kind of a hotel. But what's interesting is really none of those assets are going to last 39 years, certainly not your carpeting and those types of things. So back in the 1940s, we had, our real estate pioneers that are fighting with the IRS and going head to head and taking them on and saying, hey, I shouldn't have to depreciate this property. And back then it was 31 years. We shouldn't have to do this over that long period of time because there's a lot of assets in this building that aren't going to last that long. And hence cost seg has been born. And so essentially what it is if you have a professional, building professional come into the building like an engineer to break down all the different components of the building, the IRS will allow you to put certain segments or assets of that building into faster class lives. But you have to have a study done, which is the cost segregation study. So we're going into the property, we're segmenting certain assets, we're putting them into buckets like 5-year bucket for depreciation, a 15-year bucket for depreciation, and then the rest of it, like structure, would belong in 39 or 27.5-year bucket. And so essentially cost segregation is where you're shifting assets from the long-term bucket into faster buckets or different class lives for the depreciation. That's kind of what it is in a nutshell.
Got it. Okay. So to kind of maybe simplify it even more, we're looking at things like if we just look at our own houses and we say what, the things that aren't going to last 27 and a half years or 39 years. So maybe our appliances are moved into a different, let's call them buckets, right? So we've got a 5-year bucket, a 15-year bucket, and then the remainder, correct? So it's just two extra buckets. Is that correct?
Yeah, there are some extenuating circumstances where we have a 3-year bucket and a 7-year bucket, but usually that's for commercial property and other types of things. But for residential or for usually most real estate is just 5 and 15-year buckets. Sure.
So we could say things like you said, like carpet is going to go in a 5-year bucket. Maybe appliances can go in either the 5 or the 15-year bucket or something like. So there's different things that go. Obviously, we don't expect our water heaters to last 27 and a half years. We don't expect our furnaces to last 27 and a half years. So why are we doing straight line depreciation over that period of time when we know we're going to have to replace those things, right? So what we're doing is we're allowing people to take that depreciation number and push some of it up front so we can utilize it faster, right? So that's kind of the idea here. So my next question to that is I actually originally had a question of what types of properties you can do cost seg on, but maybe the better question is are there properties you can't do cost seg on?
Yeah, that's a way better question because I haven't really met a property that isn't good for cost seg, except if you're going to flip it. So if you're buying a property and you're renovating it to turn around and sell it, you're not going to do a cost seg because technically speaking, it never gets placed in service. So you're never going to depreciate it. Therefore, you can't break down depreciable buckets. So that's kind of your rule of thumb. And primary residences or second residences, second homes, those are not depreciable. So if you're not going to depreciate that, they're not going to be income producing, then you can't do a cost seg on it. But if you have if you have a primary residence and that you turn that into either a short-term rental or a long-term rental, then you are able to do a cost seg at that point in time. Your place in service date would be when it became a rental.
Got it. Okay. So really, if you own investment real estate, it's very likely you can do a cost seg on it. Is that a fair?
And anybody can do a cost seg. The misconception I think that people miss a lot is the utilization of the cost seg. So once you get the cost segregation study done, and what I would urge is that, you confer with your CPA or at least confer with somebody, tax attorney or somebody that understands your structure. Because if you're a passive investor and you already have passive losses and you go do a cost seg study and then you turn that into your CPA is going to look at you like you're crazy. You just wasted your money, right? Because you can't utilize it. So it really depends. I mean, if you're a real estate professional or if you have the material participation, those factors are very good fact patterns for being able to take, the cost segregation, the bonus depreciation, and all the depreciation that you can. And if bonus depreciation is designed, it's there, you're going to be able to take a lot more in depreciation than you probably need with the cost seg study. But the nice thing is that if you can't use all of the depreciation the first year, it just rolls over to subsequent years. And without penalty, right? So you can just roll it over. And essentially, most of my investors are not paying tax for 2 to 5 years.
Right. Right. Yeah. So can you explain what material participation is?
Yeah, to an extent. Material participation is interesting. There's material participation rules. And essentially when you're talking about a short-term rental, it has different rules than a long-term rental. So if you have a short-term rental and or multiple short-term rentals and you're managing it yourself and you're spending at least 150 hours a year managing that piece of property, then that actually turns the asset into an active investment, not passive. And so when you get to that point and you have now that income being active income, which is the same as your W-2 or whatever you're making at your job, then you actually have the ability to also take the deductions or the depreciation and you can offset your active income, meaning your W-2 income. So, and that's similar to the real estate professional status, which is for long-term rentals, but it also could be for short-term rentals. But the first one starting low, the material participation is really designated for those short-term rental owners that are managing it themselves.
See, and I think that's a great piece for people to know because, so many people look at the side of, okay, like you and I both know that having a real estate, designation, right? So, and again, you don't have to be a real estate agent for this, by the way. So to be designated as a real estate professional, and Kim, please correct me if you know I'm wrong on this, but my understanding is to be considered a real estate professional, there's kind of two big qualifications that you have to have. The first one is that you have to be able to prove kind of to the IRS that you spend at least 750 hours per year working in some form of real estate. So it could be property management. It could, you could be managing your own properties. That would count. And the second thing is it has to be basically your number one job, right? So you can't have you can't spend 750 hours a year managing property, but then also be a nurse for 2,000 hours per year. Am I correct in that, Kim? Okay.
Yes, you are correct in that. You can be a teacher working 10 hours a week, and then you could be a real estate professional, but then you kind of have to decide which one is going to be active, which one's going to be passive for you,
That's right.
But I think if there's somebody that's teaching for 10 hours a week, they must be doing it because they love it, which is great. But once they start seeing the benefits of having that, real estate professional status, they're going to start realizing how much more money they can bring into the family with.
Sure, exactly.
by being a real estate professional.
But I do really like the idea of the material participation because some people look at it and they go, yeah, but I'm not a real estate professional. I can't be a real estate professional. I have this other job. But knowing that if you have this material participation, like you said, it works really well with short-term rentals because I think if you're managing, 2 or 3, short-term rentals even, as an individual, I don't think there's by any stretch of the imagination that you could, even just one, I think you could justify that you might be spending 3 hours a week, managing that rental. And so if you have that material participation, and as we know, a lot of times short-term rentals can be very profitable. So, to the point where, in Colorado right now, when we're filing our taxes, if you just go buy a long-term rental, with depreciation and what it costs to leverage here, and our rents, like you're going to take a loss right off the bat. Like your cash flow is not going to be big enough to take a gain in the first place. But a short-term rental, you might see some significant cash flow. And so how can you offset that? Well, if you have this material participation, you don't have to be a real estate professional to take advantage of bonus depreciation and cost segregation and be able to use that to offset that quote unquote kind of active income. So I think that's really beneficial for people to know because I think a lot of people don't know the material participation side and they have only seen maybe even the ones that, again, understand cost segregation or have seen it. They think, oh, I got to be a real estate professional for it to really make sense. But that material participation, I think, is really important to understand as well. So
I think it is. I think it is very important, and also it's important to note that you can have a full-time job and still qualify under material participation, whereas you can't really do that if you're a real estate professional.
Right.
So there are some differences, but again, the material participation rule is not going to cover long-term rentals. It's only short-term rentals.
Exactly. Exactly. So you got to pick and choose if you've got multiple properties, pick and choose which ones you're gonna that you may benefit from on that on the cost seg. So I just want to give people kind of an example, just to kind of put a monetary figure in their head so they can see what this looks like. And so we'll use some real basic figures for the understanding. So generally speaking, when we purchase a property, let's say we buy a property, and maybe it's a townhome here in Colorado, and let's say we purchase it for $300,000. And the way that depreciation works is we can't depreciate the land. So the cost basis is going to be the cost of the property minus the land. Okay. So let's take, for example, this $300,000 property, and let's say the land is worth $25,000. So we've got a cost basis of $275,000. Okay. We're going to be able to straight line depreciate that over 27 and a half years as a residential property. So pretty simple. It's going to be $10,000 per year that we can take in depreciation that will help offset our gains on this property. Okay. So once we have this $10,000 per year depreciation, we can take that out for 27 and a half years, and we can continue to have that kind of tax savings over the years. Now, with cost segregation, what we're doing is we're taking big chunks of that and we're moving it into the 5-year and the 15-year buckets. Okay. So Kim, in general, maybe you can give me like an average. What percentage can we generally move up to, say, a 5-year bucket of the basis of that property? Do we have an idea on that?
Traditionally, yeah, I would probably say that out of a basis at 275, you're probably going to shift about 20. I would say conservatively 20% of that. So if you take 275.
Yep. So if we take 275, 20% of that is 55,000. Okay, so that adds an additional $11,000 per year in the first 5 years, right? Because we still have the 10 that we were doing over the 25, right? Or the 27 and a half, but now we're adding another 55 to that. So am I correct in thinking that now we're at 21,000 depreciation for each year?
Yeah, I would say about 10% would go into a 15-year bucket. That would be another 27.5. So that added to the 55,000 is about 82 and a half.
Perfect. Okay. So now we're taking that 15-year bucket, another 10%, and then we have overall, and again, these are fairly conservative numbers. And so now we only have a 70% of the total value of the cost basis in the 27 and a half year bucket. Okay. So what we've done is we've accelerated an extra $55,000 into the first 5 years, and we've accelerated another $27,500 into the first 15 years. Okay. So instead of having a write-off of $10,000 per year in those first 5 years, now we have a write-off of double that, right? So now all of a sudden, if we've got this, maybe we've got a really good cash flowing property, and then we've got one that was kind of negative anyway, or maybe it was neutral, from a tax standpoint. Now we've got an extra deficit that we can use to offset the cash flowing property. Or if we are a real estate professional, or if we are a material, I've lost it. What is it, Kim, again? A material participator. Thank you. Material participator. Okay. Now we can use that. We can use that whole thing and offset kind of our quote unquote active income, right? And so what we've been able to do for the last few years, since I think 2016, is we've been able to do what we call bonus depreciation. So Kim, let's take this one step further and talk about how real estate professionals are using these tax strategies to really create incredible amounts of wealth. So talk about bonus depreciation and what that does to that amount of money that we just talked about.
Yeah, so the bonus depreciation is pretty interesting because it's up to 2022, our bonus depreciation was 100%. So we'll talk about it in those terms right now, and then we'll talk about the sunsetting. But essentially, the bonus depreciation kicks in and says if you shift assets from the long-term bucket into faster buckets, anything less 20 years or less. Okay, so that includes the 5 and 15-year buckets that you were just talking about, Nick. Then you can take 100% bonus depreciation on that, meaning that you can deduct all of that in year one. You don't have to wait its respective 5 and 15 years for it. You get it right now. So that in $82,000 and some between the 5 and 15 years that we shifted out of your $275,000 purchase or your depreciable asset, you essentially get a write-off $82,000 in the first year.
Right. Which is incredibly, incredibly powerful, right? Because especially if you've got active income that you can offset it with because you're a real estate professional, or if you're, a material participant it's really, really, and so let me just take a step back here that we look at, how do these laws get put into place? How do these tax strategies come about? Well, the big thing with bonus depreciation, if I'm not mistaken, this was implemented, was this implemented with Trump's tax code?
Yeah, the 2017 Tax Cuts and Jobs Act.
Yeah. Okay. So in 2017, well, it's no coincidence to me, right, that we've got Donald Trump, who is a real estate entrepreneur and a real estate professional, okay, that has lots of friends and family in high places in the real estate world, and is able to implement a tax strategy for these people that highly benefits the ability to basically take a property. Okay. And you could have, Donald Trump has owned property for a long time. People who have owned property for a really long time are generally going to see positive gains and positive cash flow and, taxable income on their assets, because if they've held them long enough, they're seeing enough cash flow that happens. So how do you turn around and offset that? You just buy more real estate, and then you cost segregate it, you bonus depreciate it, you take a huge loss on that one and roll the other losses over to everything else that's gaining. Okay. And this is how we've talked about this in prior podcasts, but this is where we're kind of getting into the nitty gritty of it. But this is how people build tremendous amounts of wealth, is because, once again, we'll bring back the statement that I've made probably in at least 3 podcasts, but the number one expense for the wealthy and the number one expense for the rich is taxes, by far. It's not even close. We had an episode where we talked about the average individual, the average median income, their number one expense is their housing, almost always, right? That person is going to spend 30 to 35% of their income on their housing. Somebody who's making $50,000 to $100,000 a month could have a $10,000 mortgage payment, live in a big, beautiful home, and it's not even going to touch the tax expense. It's not even going to be close. So if you could take that tax expense, which for somebody making, let's say, $100,000 a month, their tax expense is somewhere in the $30,000 to $40,000 per month range. If they can do some type of tax strategy that allows them to keep that money and reinvest it, how quickly is that exponentially going to allow them to grow their wealth? And that's why cost segregation and specifically bonus depreciation has been so powerful over the last 6 to 7 years for real estate investors, and why you see a lot of people moving into opportunities, syndication opportunities, where they can get into real estate investments that will allow them a significant or will create a significant loss on that property, right? And so these are really powerful strategies that people are using, and why it gives, like I said, why it helps people grow their wealth tremendously over this period of time. So, Kim, go ahead and talk about what bonus depreciation is going to do over the next couple of years.
Yeah, so bonus depreciation is starting to sunset, because in the 2017 Tax Cuts and Jobs Act, we were given that 100% bonus depreciation on the 5 and 15-year assets, knowing that it's going to start to sunset, which means that in 2023, this year, we are starting to see a diminishment of the bonus depreciation, and it drops to 80% instead of 100. So that means the 80% of that 82,500 that we had calculated, 80% of that would be a tax deduction in the first year, and the remainder of it will be dispersed over the 5 and 15-year buckets, respectively. So then in 2024, it drops to 60%, and then 40%, then 20%, and then in 2027, we have no bonus depreciation. So we're just reverting back to our same original 5 and 15-year buckets, which is still beneficial. It's still probably double than what we normally would see in straight line depreciation, as Nick said, but it's not as powerful as it is now. Personally, since 2017, I will say that I've probably been able to triple my net worth, my personal net worth, just using this strategy.
Yeah.
So if you can take whatever you think you're worth right now and exponentially, And I was a real estate investor. So, back then, and then it just catapulted my net worth. And one other thing that I want to add to that, that you said, Nick, earlier about the reason that this came out, back in 2017, we were still struggling a little bit, from the downturn in real estate. Prices didn't take off the way that they hadn't seen. Certainly now, right? We have inflation. Now we have a tax bill that is reducing our inflation because it went too high, too fast. But back in 2017, when this was written, it was really there to incentivize real estate owners to reinvest in real estate and also improvements, which would mean hiring, right? That you're hiring people to do the work. You're hiring contractors. You're putting people back to work. And that was the biggest focus, if you remember correctly, about the Tax Cuts and Jobs Act, is because we wanted to create more jobs. So if you're taking, naturally, if you have a big, huge tax deduction and you're saving a ton of money instead of paying Uncle Sam, yes, you can put that money into a savings account, but why not reinvest that and spend that in the community that you're living in? And that was really the benefit to it. And it worked very, very well, so much so that now Biden has had to reverse that a little bit and put a kibosh on the inflation because it was so crazy. At Engineered Tax Services, we, not getting political or anything like that, but we do believe everyone should pay tax. But there is nothing in the code that says you have to leave a tip. So it's important to know that these tax incentives are out there to incentivize us as real estate investors to do certain things. We are just following suit. It's not against the law. It's not unpatriotic. I get that a lot. It's like, we should be paying tax. We should be paying tax. But there are incentives, and they say in lieu of you paying tax, you could do these types of things and offset your tax, because we know that if you do this, then you're going to turn around and invest that into something that's more important for us to incentivize. And so this is a great way for the government to turn this on or off when they need it. And this has always been a bipartisan bill. It wasn't one side or the other. It wasn't Democrats versus Republican. This was bipartisan. This was everybody working together saying, we need some incentives because we know how many people are in real estate out there. And we know that if we can incentivize to do something, we can make them do things that we want them to do, which what happened? Exactly what they wanted to have happen. Increased values, people went back to work, the unemployment rate dropped. It was exactly the way they designed it in 2017. So, people can say whatever they want to say about rich getting richer or, those types of things. But the reason for the incentives is solely so that we can do something else with that and reinvest it, which is exactly what happened. So it was all by design.
Exactly. And I will say, I'll reiterate one of the statements I'd made before, which is that almost exactly what you said, as far as like you should pay taxes, but you shouldn't leave a tip. And the idea is that the tax code is a series of incentives. Okay. And we've talked about this before, how like the tax code, I don't know how many pages it is, hundreds and hundreds of pages, let's call it 700 pages long or something like that. Right. But the reality is, how much is it?
I think it's like 17,000 pages.
Okay, it's crazy. It's like it's incredibly long. But the idea behind it is like something like 98% of it is what you can do and what you're incentivized to do, and the other 2% is what you can't do. Right? It's a series of it's a series of incentives for people. And what people don't understand is when you get these tax incentives, it's so that it builds the economy, right? We're in a capitalist nation, right? And so we encourage entrepreneurism. We encourage building business. We encourage small business, right? And so we give people tax incentives in order to do that. And my argument to anybody that wants to come and say, well, everybody should pay their fair share, I completely agree. But if you're the normal W-2 making $50,000, $60,000 a year, whatever it is, when your tax guy, when your CPA comes to you at the end of the year, when you file your taxes and says, hey, you're eligible for a $12,000 or a $24,000 standard deduction, it'll save you $3,000 in taxes. I don't know a soul who's ever been like, you know what? Let's go ahead. Let's just take that out of there. I'll just pay the tax that's my fair share. So nobody does that. So why would a real estate professional do the same thing where we all hire tax people. We all hire CPAs, and they do our taxes, and they go, "Hey, nice job with the cost seg this year. Nice job with the real estate. We're going to do some stuff here, and this is going to be your tax liability because you took a loss over here." And we go, "Great, thanks so much." Like it's no different than what the average person is doing, and so we're not, nobody's breaking any laws here, and so it like you said, it's an incentive to stimulate the economy. It's the incentive to get those people to reinvest their money, because what happens is we stagnate the economy by the ultra wealthy and people keeping money in their bank accounts. Okay, that's not good for the economy, right? People just putting their savings away is not good. We need that money to be spent. That's what drives GDP. That's what drives the economy, right? And so I think that's really important, and I love that. I love your quote there. So hopefully that'll get turned into like a little quote there. But you don't have to leave a tip. I love that. So one of the questions I get on this too is that hey, that's all well and good that you depreciate the heck out of the property and you take this massive loss, but if you're front loading all that depreciation, when you sell the property, don't you have to recapture that anyway? That's like the next question. Well, you're going to have to just, if you sell it in 5 years or whatever, then you're going to have these, you're going to recapture that. So you're just going to give it back anyway. So talk a little bit on that and maybe what the following strategy is after that.
Yeah. I love analogies, and I speak in analogies because I think it helps people understand and have concepts resonate with them. If you're going to just do a cost seg study and nothing else, I think that it's like building a house with only a hammer. So like if all you had was a hammer and you're plugging away in 2x4s and nails and a hammer, and you don't have a saw and you don't have a level and you don't have all these other tools, your house isn't going to do very well, right? It's probably going to fall down. And to be honest with you, that's the way I look at cost segregation in a financial house, right? In a financial picture, you don't want to gel. There's 1031 exchanges. There's all kinds of things that you could do that are tools in the tool belt to help you. Yes, there is recapture. There's some huge naysayers out there, and it just tickles me to death. I start watching some of these YouTube videos about cost seg and how, this is not as good as it's cracked up to be. And then they do all the analysis, and it's like, yeah, and they're not telling you about all the other tools that you can incorporate it with the cost seg study. So, I always want to make sure to advise you about the other tools. There's other things that you can do to manage your finances. If you're taking the bonus depreciation, think of it as taking an advance on a paycheck. So you start a new job and you tell your boss, hey, give me 5 years pay up front and I'll work for you for 5 years. And then you turn around and quit your job in year 2. Well, you're going to owe back 3 years of pay, right? That's the same essentially what bonus depreciation is. You're taking an advance on a paycheck as a benefit to do something. Now, if somebody was going to pay me for 5 years up front, and I took all that money and I just threw it in a savings account and started spending it at 0% interest and no returns, what's the point of getting the advance on it? But if I was given 5 years up front and then I took and invested that money and did something with it, then when I had to pay back my 3 years, I would actually have to pay back a lot less because I made money on his money, right? Without really earning it. Well, that's the same thing with cost seg. If you're going to literally take the tax deduction and you're going to throw that money in a savings account like Nick was talking about and do nothing with it, then don't spend the money on doing a cost seg study. First of all, that's ridiculous. You really want to use that money to help you make more money, right? Go buy another property, reinvest in the improvements to pay for those improvements so that you can actually generate more income for yourself, right? Because if you improve the property, you can charge more. So there's these things that you really want to do with that money, and because otherwise, it's waste. So let's say you took the 5 years up front and you sold the building, right? And you have recaptured pay. That's essentially paying back on a prorated level what's left. Okay. And so the tool that I use is like there was a situation. I bought a mobile home park in 2019, and in 2020, I was honestly really good with buying it when I did, because I had a million people knocking on my door every single day. I would have phone calls constantly, can we buy your park? Can we buy your park? And I'm just like, leave me alone. It's like, it's my park. But ultimately I did sell it about a year later. And, I think at that point in time, and I only paid, it was a very small part of the first one. And I only paid like $575 for it. And they were offering me $1.5 million a year later. And I didn't really put any more than about $20,000 into this park. But I had done some things. I raised rents and I went in and I made it a little bit nicer. And I actually, was able to get everybody on electronic payments, which was very valuable for a property manager. Like I did all these types of things that I knew the value would increase. And I had these, ridiculous offers. Well, I had done a cost seg study and mobile home parks are killer. They're probably the number 3 best performer in cost segregation. So when I bought it for $575, this is the smallest first park, but when I bought it for $575, I was able to write off about 75% of it. So I took a tax deduction of about $400,000 the first year. And then when I sold it, I was like, crap, now I have to think about this, right? So I have to strategize my own plan. And I say, okay, I'm going to have some recapture to pay. So what is that going to look like? And I had 4 years of recapture, right? So it wasn't just a little bit. And so you have a couple choices. You can do a 1031 exchange. Then there's no recapture and you just roll that gain over into another property. You can invest in, you can sell the property and you can turn around and invest in an opportunity zone fund or create your own opportunity zone fund. What I chose to do, third option, was to sell the property, take my gain in the same tax year, buy another property, about 3 times the size. And I took the bonus depreciation. I did not do a 1031 exchange because I didn't want to kick the can down the road. And I used my 100% bonus depreciation as another tax deduction to offset not only the gain from the park, but also my recapture. Because I had a big tax bill, right? Not only did I have to cover the accelerated depreciation that I took, but I also had to cover the gain, which was about $1 million in gain that I had to offset. So I had about $1.4 million that I had to offset. But if I go buy a $3 million property and I get to take a, $2.5 or $3 million tax deduction, then you basically have those benefits. So tools, right? Tools. So don't let anyone discourage you from doing it. Just make sure that you have a plan. You have a professional that you can turn to. You have somebody that you trust, a mentor, a tax attorney, somebody like Nick, who you can reach out to and just be like, hey, here's my situation. You can certainly reach out to me. And I can help you, through some of those scenarios and give you some ideas of what to do and where to go from there.
That's awesome. Yeah, I think that, and then again, what we talked about in the past is just to reiterate, this is how people build generational and legacy wealth, right? Is because not only does, some people say, well, at some point you got to pay the piper, right? But not always, right? But because the way the tax code is written, you could 1031 these properties, for example, all the way down the road. And as the current tax code is written, you die with those properties and leave them to your heirs. And now all of a sudden they get what's called step up basis. And now they get to acquire those properties at the current value that they are and sell them at zero gain. And so there is a point where if you do things the right way and how these legacy portfolios are created created through, creating generational wealth, the idea behind that is they're just using tax strategies and they're just pushing the tax, or they're deferring the tax down the road until the point where it kind of just poof disappears, right? There are tax strategies where you can 1031 into a property and turn it into a 1031 into a rental property. Maybe it's this big beautiful mansion on the beach in California or something like that, and then you decide you want to retire and go move into that property, and now it becomes your personal property, and then poof, there's so many great opportunities to take advantage of the strategies in the tax code that people don't really think of. And so that's why it's so important to have a professional help you with whatever route you're going to take with your real estate investing. And it's not just one person. You can call me, but I stop at a certain level, right? And then we need to involve your CPA, and then we need to involve Kim and somebody who does the cost segregation. And then we need to involve, Kim's parent company for ultra high net worth individuals and how they create, they create opportunities for tax savings for those people, right? Like this is a team of people, and that's why you see when you hear like I don't know how many accountants Donald Trump has, but it's a lot. I don't know how many lawyers he has, but it's a lot. You think, why do they need more than one lawyer? Why do they need more than? Donald Trump needs more than one lawyer for other reasons, but why do they need more than? Why do they need more than one CPA, right? Because they all understand different strategies and having different eyes on it, right? Like if Kim and I were to assess a real estate strategy that somebody came in with, I can almost guarantee you we would assess it differently. Like we would look at it and offer different paths, different opportunities, right? And one of the things I really enjoy talking to Kim about is some of the outside the box strategies that we use. And we don't really have time to get into it, but I think I'd love to have Kim back on another call on another podcast, because there's so much more that we didn't necessarily talk about or don't have the time to talk about, but there's so many other just strategies and incentives. Again, we're not going to get into it, but Kim bought a gas station, as she told you before, and there was a reason behind that, right, Kim? There was a tax strategy behind that. It wasn't because you like aspired to be. You're like, man, I've always wanted to just own a gas station, right? Like, there's this tax strategy behind that, right? So, just like I've said in prior podcasts, like real estate investors don't buy real estate and don't buy investment properties because we aspired to be a landlord, right? This is a business, right? Kim, I highly doubt, aspired to just be like, man, I just really want to own mobile home parks because I really want to I really want to implement systems where people pay electronically. And it's an investment strategy. It's a business. And it's there so that we can create wealth for our heirs, for ourselves, so that we can retire early, so that we can do what we want to do. So anyway, Kim, so much great information on this. I feel like we barely even scratched the surface, but people get bored of my podcast probably far earlier than I take these on. But the information is really priceless. And I can tell you just personal experience for myself. Like, I did cost segregation with Kim and her company. It was a great experience. I did it last year. And the tax savings is really incredible. It is one of the most powerful things. And if you listen to, I believe it was episode number 8 of our podcast, you'll hear me and Matt talking about, and I'm trying to convince him that I had him order, what the most important things were in real estate investing. We talked about cash flow, appreciation, capital preservation, and tax incentives. And I said, order them. Which one's the most important? The average person is, cash flow, appreciation, and the other ones. And I said, by the end of this podcast, I think I can get you to understand that I think the tax incentive is actually by far the number one reason to invest in real estate. And the average, again, if you own one property, there's not, you're not going to see this tremendous thing, but the ability to snowball that property into property number 2 and 3 and 4 and 5, and just keep going and use those tax strategies and tax incentives to really build like this tremendous amount of wealth in this big portfolio. Then I do argue that tax incentive is by far the number one reason to invest in real estate. So I don't know, Kim, I don't know what you think about on that, but that was my overall consensus a few podcasts ago.
Yeah, I think right now, especially with the bonus depreciation where it's at, it's a no-brainer. I mean, it's just one of those things. You just can't. Nobody can argue that, especially the ones that are utilizing it. And I always say, once you go cost seg, you never go back.
Yeah,
it's like, because it does create this chain reaction. You're like, wow, I really need to offset. I need to buy something this year, and that's exactly what it was designed for. So. Thanks so much for the opportunity. Awesome.
Well, thank you for being here today. Appreciate all the great information. Again, Kim is a fantastic resource. She's highly knowledgeable in this. I think you're on the tax committee in Washington, D.C. or something like that, or you were, or you still are?
Yeah, I'm on the tax committee for the Real Estate Roundtable in Washington, D.C. So that's the roundtable is made up of the largest real estate owners in the country.
That's awesome. So, I mean, you're collaborating with lawmakers, and you have board positions, and that stuff is fantastic. And you don't get there without really understanding your craft. And so, like Kim said, there's so much bad information out there. And so I feel blessed to have you here today because I feel like you are a top resource for this. And so I feel really good about putting my stamp on this and saying like, hey, this is the person you should listen to regarding cost seg and tax strategies regarding real estate. So again, I want to thank you so much. Kim Lochridge with Engineer Tax Services. Thank you for being here today. I would love to have you back maybe on another one down the road and talk about some other tax strategies if you're open to it.
I'm totally open to it.
Cool.
Yeah, I'd be happy to.
Awesome.
Yeah.
Hopefully this is up your, I always love talking about things I'm passionate about, and I think it's probably something you're very passionate about. So we could always have a good conversation regarding it.
Yeah, for sure.
Awesome. Well, thank you so much. And for everybody listening, thanks for tuning in to this episode. Please remember, every Wednesday we have new episodes. Catch us on all your podcast favorite podcast players and YouTube, whatever works for you. Drop us a comment, drop us a like, and send it to your friends if they want to learn something about real estate. Hopefully we can help them out. And remember, go out today, do something great, and remember to always live big.
Thanks for joining us for this episode of the Live Big podcast. For even more real estate and investment resources, go to blackyetigroup.com/resources. and download Nick's complete guide to running your own rental properties. Tune back in next week for another episode, and until then, live big.
Live Big does not provide investment, legal, or tax advice, and nothing herein should be construed as being financial, legal, tax, or other advice. Live Big does not represent that any securities or services discussed are suitable for any investor. No investment or other decision should be made solely based on the contents or information found on the website or podcast. When making a decision about your investments, you should seek the advice of a professional financial advisor or qualified expert.